Great. This is Bennett Tchaikovsky, and welcome. We're going to wrap up here today warranty liabilities, which is part of current liabilities, or part three of this series for intermediate accounting. My disclaimer and copyright notice: the information and opinions in this presentation are those of yours truly and not my employers or any other affiliated organizations, including but not limited to Irvine Valley College and the South Atlantic County Community College District. This presentation is for entertainment. Well, if my cat shows up, it's entertainment, but this is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by myself, Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I will make reference to publicly available information that is going to be the copyright of other parties. I do not claim any right or the copyright that is referenced in those third parties. So now we're kind of moving on to like this last sequence of, current liabilities that I want to kind of focus on, but this is warranty liabilities. And this sometimes may be an issue for certain companies. So warranty is basically, it's a promise you're basically making from a seller to a buyer that it's going to basically make good on as long as if there's a deficiency on quantity, quality, or performance of a product or a service. And the key thing to remember in this, and I think this is referring to some of my prior lectures, is we want to book the warranty, or we want to book the warranty expense because it relates to that sale. We're going to hit it when the sale is made. So that's going to be the really important thing. And that basically is going to be following our matching of principle. We want to be matching those expenses with the revenues that they help generate. And we're going to be creating a warranty liability on a balance sheet. And how that gets classified, we'll see how that works a little bit later. So there are a couple different types of warranties or assurance types, basically, versus service types. The assurance type is that this is really kind of embedded into the warning. So for example, like Costco, if you're purchasing, say, like, I don't know, like a non-electronic item, you can pretty much return it within a certain period of time. Um, you know, and is that going to be included in the sales price? This is an assurance warranty. Yes. We record it at the time of sale, and then revenue recognition, not really applicable because it's not a separate component. And this might be a standard 1-year manufacturer warranty. Now, this is opposed to a service type warranty that is usually going to be sold separately. When you basically buy a TV from Costco, they may say, well, would you like to buy this warranty for $40? You buy it, hopefully you never have to use it, but it's basically going to report it as like unearned revenue. And then you're going to recognize that revenue over the warranty period along with the associated costs. And this is usually going to be purchased separately. And when we kind of look at this, like the assurance type of warranty, again, you're going to go through and book it at the time of the sale. And when we look at service type warranties, again, it's sold separately basically from that product. And we're going to recognize it as unearned warranty revenue, and we will go through and recognize it over the period of time or as appropriate. So this is just kind of a summary of various different assurance type and warranty liabilities. Generally, if it's assurance, you're debiting the cash, crediting sales revenue, you'll be debiting cost of goods sold and inventory. And then at that point in time, you're going to basically recreate the warranty liability. Service type claims right over here. You're basically going through and reporting the sale as cash, crediting unearned revenue, and then you'll go through and recognize that as revenue over time. So how do we go through and estimate warranty costs? Well, a lot of it's going to be like, how much time, like, is this a new product? Did we beta test it? There's going to be a lot of different factors. And, what are the product failure rates? How much testing did the company go through and do? Does this company know what they're doing? When you look at, warranties, you really have to look at the history of the particular company. And there's so many different factors in terms of the likelihood. Will customers make claims? Have there been recalls? Is the company really actively trying to make sure that there are not defective products that are out there? And these, as accountants, are all different types of factors that we want to take into consideration because if a company underestimates its warranty liability, this could basically be inflating the current period income, which is a huge problem. Now, the inverse of that is that if they're going to say, oh, well, we're going to recognize all these warranty costs, then you're basically trying to kind of go through and, basically, underestimate warranty costs, then you might be depressing income. Now, this is not with most companies will be doing this, but this is a kind of a something we want to be aware of as accountants and auditors in terms of how we're going through. We want to basically make sure that, hey, is the way we're going through and recording warranty, expenses, is this, what's happening here? I would also kind of recommend too that when you have clients as a publicly traded company, use something like Google Alerts so that you get warnings if there's ever like a product that's basically coming back in that might be defective, something like that. Always a good way to kind of go through and look at things. And again, what do analysts look for? Well, are they recognizing more warranty expense as a percentage of sales or less? How is this kind of comparing to the peers of the company? Unusual changes in the warranty expense without explanation. So again, this is something where we want to just kind of be mindful of it. So under GAAP, we are going to kind of go through and disclose our warranties. And for this one today, I've kind of brought up Best Buy. So this is basically the 10K of Best Buy. This is Best Buy's 10K. And if I just type in this warranty, basically, when we kind of look at this, you kind of see some like we utilize third-party vendors for certain aspects of our operations. So what they might do, Best Buy, they may not do the warranty themselves, they may outsource it. And because we have greater responsibilities for products and our exclusive brand labels, recalls or safety issues, including customers for warranty replacements. So again, if it's their own self-branded item, there may be more of a warranty issue. For Costco, this would probably be equivalent to the Kirkland brand. Comparable sales, warranty, and over here you can kind of see that they're kind of going through and talking here about like basically warranty repairs or the like. And if we kind of go through and finish this up, basically you can kind of see that over here that you basically see that, okay, when we are the agent, basically, for example, if Best Buy is going through and, acting as like the agent to sell like these third-party warranties, they're going to basically get a commission, which is about less than 1% of their revenue in those different years. So it can be a pretty significant source of income, especially for a company like Best Buy. So basically, for GAAP, we've got to estimate this cost that we expect to incur, the nature of the warranty, and to estimate the range of loss if we can't make that estimate. And again, you're going to basically see footnote disclosure. What are the warranty programs? What's the warranty period? The changes in the warranty liability during the period, and what methodology are we going through and using to estimate those warranty costs? And when we're looking at essentially the five-step revenue recognition model, and this is going to be something that comes from the last part of intermediate accounting, and I'm probably going to make a separate video just because there's going to be several students in my intermediate two class this summer of 2026 that you haven't been exposed to the first semester of 202A. So I'm going to kind of go over some of those concepts. But the key thing is over here is those five steps of revenue recognition. It used to be is revenue realized and realizable, or is it earned? But now there's five steps. You got to identify the contract. What are the performance obligations? What's the transaction price? Allocate the price of the performance obligations, and then you're going to go through and recognize the revenue. So again, the key distinction between the assurance type, it's not a separate performance obligation, and then the service type, it is considered to be a separate performance obligation. So let's go ahead and take a look at the example that I've kind of come up for you with today. is we've got over here, we've got Rockwell sells computers under a 3-year warranty contract that requires us to replace defective parts and provide the necessary labor. During 2021, the company sold 600 computers for $5,000 each cash. The computers cost us $2,000 each. On the basis of prior experience, the 3-year warranty costs are estimated to be $400 for parts and $220 basically labor per unit, so that all sales occurred on this one day. The warranty is not sold separately from the computer. So it's going to be a assurance type warranty, right? Because it's going to be assurance, because it is not going to be a separate performance obligation. So the company generally experiences warranty costs evenly through the 3-year warranty period. So let's go ahead and do our first things first. We're going to go ahead and record the sale of the computers on 12/31/21. Okay. When we make a sale, there's two things that are happening, right? So we've got to show, and again, let's just kind of go remember our friends. And our friends are really going to be over here. Our assets are equal to our liabilities plus our owner's equity. We've got expenses, we've got revenues, and we've got debits and credits. Like our nation's capital, where crazy stuff happens every day, is Washington debit credit. I do not want to end up in the emergency room during the weekend. And lastly, I've got assets are equal to our AELOE. Assets equals liabilities plus owner's equity. Why is this so important? I report assets generally have debit balances. They are increased with debits and they are decreased with credits. Liabilities and owner's equity typically have credit balances. They're increased with credits, decreased with debits. We record expenses with debits, revenues with credit. So when I make a sale, right, I've got two things going on. First thing I got to do is I'm going to basically debit cash or accounts receivable. I'm going to report sales revenue. And at the same time, we have inventory that's coming off of our books. So I'm going to debit cost of goods sold, which is basically an expense. And I debit my expenses. I'm going to be crediting inventory. So to record sale of computers, and then over here, this is basically going to be 5,000 times 600 or $3 million. And then at the same time, I'm going to be reporting the cost of those computers. So this is going to be 600 times 5,000. This is going to be 600 times 2,000. Good computers. Okay. Okay, so over here, I've got cost of goods sold and I've got inventory coming down for the same amount. Now, when I basically make the sale, what I want to go through and do is I want to go through and record a warranty liability. Okay, so what this is telling me is that the way I want to do this, I'm going to have warranty expense. I'm going to credit warranty liability. Remember, for matching purposes, we want to record this when we make the sale. Sometimes if the sales are made at the beginning of the year, you'll basically make the accrual, but the importance is that the entire expense should be recorded in the period we're making the sale. Now, the amount of my warranty expense, what is this exactly going to be? Well, it's basically 400 for parts and 220 for labor per unit. So right over here, this is going to be 400 plus 220 or a total of 620. So we're going to have 620 times basically a total of times 600 or for a total of 372,000. Okay. Now here's something that's very important. How do we classify this warranty liability on our balance sheet as of 12/31/21? Well, on my balance sheet, under my liabilities, I'm going to have current liabilities, and then I'm going to have non-current liabilities. Now, the key important thing is when we're looking at this is what does current mean? It means it's going to be paid within the next year. If this is telling me right here is that, well, at the 3-year warranty period, And on the basis of prior experience, the 3-year warranty costs are estimated to be this. And that basically, so what my current liability is going to be is going to be 372 divided by 3, or a third of this. And then the remaining will basically be, so we would have over here warranty liability current, and then we would have a warranty liability non-current. So this would basically be 372 minus the 124,000, or 248. 372. So that's how we would disclose it on our balance sheet as of 12/31/21. Remember, the current liability is going to be that obligation for the coming year, and that's how we would do it. Now, assuming that the warranty costs in 2022 were $48,000 for parts and $26,400 for labor. And this also tells us that this is basically the parts and labor. We would basically prior experience. So we've got those two components. Okay, so it's kind of helping us out here by giving us some on 12/31/22. So kind of over here, right? So basically, when I start paying out my warranty costs, I'm going to basically be relieving the warranty liability. Okay, now the amount that I'm going to be relieving the warranty liability for is going to be the 48,000 plus 26,400. Or 74,400. Now, it's telling us here too, we can assume that the labor was paid for in cash and the parts were taken out of any inventory held by the company. So here we're going to credit inventory for 48,000, and then we're going to credit cash over here for 26,400 to record costs against the warranty liability. Okay, so once we go through and do this, right? Like, what is an MI? And I didn't ask for this in this question, but right over here, this is not hitting any sort of expense. Remember, we recorded the expense when we made the sale, basically for matching purposes. This is really over here is we're now kind of saying, okay, this is where we are now. Now, what's interesting is, well, what would my warranty liability kind of look like now? Well, if I had to do a balance sheet disclosure as of 12/31, basically as of 12/31/22, right? So my warranty liability started out at 372,000. I relieved it of about 74,700. So right over here, my remaining warranty liability is going to be 297,600. Now, this is where a lot of judgment would basically have to kind of come into play, because we know, for example, like, okay, so as of 12/31/22, we know that the non-current portion is no longer going to be 248. The non-current portion is going to basically be that final year, or the 372,000 divided by 3, or 124,000. Now, if we say that that's non-current, then we would basically say, well, the remaining amount of this is going to be 173,000. And here's where we get into some kind of discussions: is, do we overestimate our warranty liability? Do we now need to make adjustments in the future? Are we expecting a large amount to be like more warranty costs to come in year 2? Remember, we're not perfect when we're going through and making these different types of estimates. But again, it's management, warranties, it's like depreciation expense, it's bad debt expense. There's so many different estimates, and we're not going to be perfect. Rather, what we want to be trying to do is to be using historical information to basically make those best estimates possible, right? And we want to document why we chose this and why we basically went said, okay, well, it was a brand new product. We didn't know we actually made it better than we thought, right? So that's going to kind of be where we're going to kind of go with that. So in any event, that was that one question for you. And we're going to kind of end this now. So this is thank you for watching. Please remember to like and subscribe. Feel free to leave a comment or email me at ibc30cpa@gmail.com. I will now be kind of going through, we're done with current liabilities. I'm now going to go into non-current liabilities will be the next section. That's going to take me a lot longer to do than this one because it's a lot more complicated because we're dealing with bonds. I'm also going to go back and kind of revisit some of the zero interest bearing notes where we have installment plans, which is really exciting. But we will be going through and doing that. We'll be doing bonds in between interest periods. It's going to be fun, exciting. It's accounting. See you guys soon. Have a great night or a great day wherever you may be. And I look forward to seeing you on the next video. Have a great day.